Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, June 24th, 2016. A lot going on in the financial markets today following the Brexit vote. So let's go ahead and dive into the charts. What I'll do in this video is a quick overview on just a few of the more important things that I see. I mean, there's a lot out there, and over the next couple days here throughout the weekend, I'll break it down into smaller videos and written posts with charts covering individual sectors, markets, anything that stands out. So this will be a quick overview. We'll start out here on the pound sterling US dollar pair. This is a chart I put up last night. This is a weekly chart going back all the way to 2008. So what you can see here is we had some major reaction lows all the way back in looks like early 2009, and that is around the 135-ish, 136-ish level, and that's so far where we've call that a hammer, but we pierced through there. And as I mentioned last night, when you have sharp moves in any security, waterfall sell-offs, panic selling, it is more than common, almost the norm, to see an overshoot of a support, or if it's an upside move like this, an overshoot of a resistance level before trading normalizes. So the fact that we pierced below there is perfectly normal. More importantly is that trading has normalized there since. I put up this chart last night, a 1-minute chart. Actually, we were right here at the time. And what I did, I moved some of my the cash that's in my trading account and from dollars into pounds just to get a little pop here, a couple percentage points. But this is the 1-minute chart. So you can see that the pound is really stabilized against the dollar right now since last night. We broke out of this. I had this bullish falling wedge. This is where the chart picked up. If I put a horizontal line right here, this is where we were last night. Somewhere in there, we were in that wedge. We broke out, went up, and took out this other downtrend line, potential downtrend line. There's only a few reactions, and fell shy of this target. These are additional upside targets I think will be hit. If you're trading currencies, or maybe you live in the UK, you have some money in the pound. This is a level to watch now. I have it at 135,473. You can see numerous. Well, going back to the left, we have one little reaction there so far, but we have a reaction, reactions from below. So this is a level to watch, and again, I think we might see some upside. And I know a lot of people don't trade currency, so I'll move on. I just wanted to hit on that for those of you that are interested. All right, let's talk about the markets. Starting out with the SPY. What's happened today is quite bearish. I mean, there's no other way to chalk that up. Now, I know some people dismiss it as a one-off thing due to the Brexit vote. I'm more of a purist in the charts, thinking that things are priced in. I've been making the case very consistently for weeks now that we have a divergent high, negative divergence on the daily time frame, which these are typically my triggers. These are what I look for what I call tradable, swing tradable trend reversals. Divergent lows like we had back here. It's not drawn out. I've covered this chart 100 times. Divergent low leads to a move up. Divergent highs. I've had other charts where I've showed all the divergences going back the last few years. They've all played out for trend reversals. I don't see why this one will be any different. So when we made that divergent high, it was also on a failed breakout. Both the downtrend line off the 2015 bull market highs as well. We had that horizontal level, so that was a failure. We tried to challenge that level again yesterday and failed there. We just pretty much closed right up on there and moved back down below. So at this point, we've gapped down well below this ascending broadening wedge pattern here that I've been highlighting. So we've gapped below it. That is clearly a bearish technical event. And again, whether you want to just chalk it up to the Brexit vote or say it was priced into the charts, that's up to you. But the facts are the facts. That's a bearish technical event. But as I mentioned today, 203. See this 203 level here? You have a reaction low. You have a big gap back here. You have quite a few reactions from above and below as you follow my cursor to the left. So that is a significant level. And it's also, if you look at this, the volume up price histogram bars, the majority of trading over the last couple years, this has been what appears to me a very large, nearly 2-year topping process in the S&P 500. We'll look at it on a weekly chart. You'll see it a little bit better there. Here it just looks like, sideways trading action. But this has been a large topping pattern, and the bulk of it is up here. You can see from the volume price histogram bars. So when we drop below 203, we've pretty much taken out all the people that have positioned long here. They're all underwater at that point. So I put that a pretty important technical level, and I do think it'll go. I mentioned this morning, the initial tags, we haven't visited that level since all the way back here in, what was that, over a month ago. So this is the first tag of that level in a while. We hit it in pre-market trading, and so far we had a reaction, a bounce off there, and that reaction didn't go very far. We've come back down. We're not far off that level now. So my expectation is we take that out. It'll probably have to be on next week unless we have some type of panic selling into the close where you see a lot of people try to exit their longs or short the market, but I doubt that. I think we'll probably hold above it. And the ideal scenario, hard to say if it'll happen, would be a big gap down on Monday to just leave, trap the longs in and leave those that want to be short but don't have the gumption to do so now, deny them an ideal entry. That just makes for a longer term bearish case. So 203 goes, we're looking at 199.85 as a support level, and ultimately I think that takes us down to this 195 level. Here's the SPY on the weekly chart just to talk about that downtrend line, and you can see the topping pattern. Here's our bull market right here, and we had corrections along the way, which are normal, part of a bull market, but this sideways action just appears to be a long, prolonged topping pattern so far. But we're if you're bullish, we're towards the top of that range. So a breakout is possible. I'm not going to say, declare with 100% certainty that the bull market is over. You just can't do that. We're too close to the highs. Again, the SPY looks better than the Nasdaq 100, which has been our leading index for excuse me, many years. So that's in worse shape, the small caps, etc. So the SPY is doing a little better than most, and of course not too far from its highs. But that's what we want to look for. And if you zoom in really close, that trend line that I just mentioned there, look how beautiful. Look at the action. Look how many candlestick wicks. 2, 3, 4, 5. And then this is beautiful right here. This is that fake out that I pointed out on the daily time frame. This is why longer term traders like to use the weekly charts, and all that matters on a weekly chart is your close. So this was an intra-week breakout, but yet the weekly candlestick closed right back below that line. So there's another one, multiple candlesticks. That's just a downtrend line. It's a very gradual downsloping trend line, but yet it's one that has not been taken out. And you can see here the SPY's been making lower lows. So overall, it is one large downtrend for the last year and a half or so. But I really, to be honest, you want to call that more of a sideways trading range. It is slightly downsloping. And ultimately, the fate of this market will be decided on an upside or a downside resolution to this. You'd probably want to put a horizontal line on the highs. And I'll even tell you, if that happened, let's just say in the next 2 weeks, we punched above there. I don't think that, to me, there's still enough bearishness in the chart, bearish technicals, that if we did have a breakout, I would not flip, at least not right away from bearish to bullish. I would think that breakout, it would have a high chance of failing. I would be watching the Nasdaq Composite, the small caps, the mid caps, all the other indices, because again, the SPY's close to the highs, and to see a solid and healthy breakout, there's a lot more than you want to see than just a week or two trading above that level. So enough on that. Let's get away from there. I will point out the PPO looks poised for a bearish crossover. Those are pretty good trend signals, trend change indicators when the PPO makes a bearish or bullish cross. And there's still some work to be done. The RSI is holding above that 50 level right now. The PPO itself is above the zero line. When that crosses down below the zero line, when the RSI is back below 50. And when we really continue, like I said, most importantly, near term is that 203 level. Let's see what happens there. If that goes, I think it'll be pretty bearish. All right, enough on the SPY. Let's get to the Qs. Wrap this up. We have a similar important support level at around 104.40, listed as 104.50 earlier today, but we really have this reaction high back here, this candle right there. I'm grabbing it. 104.40 is a low. So let's call it 104.40 to be safe. When in doubt, If I'm looking at 104.50, 104.40, and that's a support, I'll go for the lowest of the levels, not the highest. I don't want to go ever trigger a breakdown. And what I mean by that is, I'm already short. As most I've been short. Some of the things have been stopped out and clipped lately. Just had some stops barely run on the upside, but I still have quite a bit of, especially those 3-time leverage sector ETFs on the short side that I'm holding on. And the next sell signal will be a break of both that 104.40 level and that, what I say on the SPY, the 203 was it, I think. So those need to both go. That's when trading the markets, especially watch the large caps. The large caps are going to lead the market. I'm not going to dive in headfirst short on a breakdown on the IWM if the SPY and the Qs are right at support, because if the large caps catch support and move up, the small caps are probably going to follow suit. So those are the levels I'm watching, and if that goes, here's a level at 103.13. But our next big support level is all the way down here. We have a zone around 99.50 to 99.90. We'll call it 100-ish level. And then we have some additional levels. So let's just take it as it comes. So again, this will have to be continued next week more than likely. But I wanted to kind of go over these levels now, give you an idea what I'm looking at. And while we're here, we'll just take a quick look at some of the top components. I won't go through them all. Apple, that 92.50, forever and a day, I pointed out all the way back here, was a critical support level. We had a very solid impulsive breakdown confirmed on volume, an impulsive candlestick. And then the white knight came riding in, Warren Buffett, and saved the day, disclosing that he's taken a big stake in Apple, or Berkshire Hathaway has. I called it the Buffett rally, and I already went over this chart quite a bit. Tried to enter a gap. It was number one, it was bearish that when we entered the gap that we couldn't backfill it. And now you can see here that almost all of the Buffett rally has now been faded. And we're back at that 92.50 level. The Apple has no business breaking that down again. If it does, it would be quite bearish. And my expectation is that it will. Here's the 60-minute chart I've been updating for a while. We've been on a sell signal there. We're still in that descending price channel that I highlighted before. And so, the near-term trend is down in Apple, and just watch that 92.50 level on the daily chart for a solid break and close below. That would be bearish for Apple. Alphabet, that potential head and shoulders. I'll look at the chart of the other share class. Let me go to Microsoft first. Microsoft, pretty well-defined support zone. I mean, we're looking here at a 2-year daily chart. So look at this reaction high, reaction high, reaction high. At this support zone, reaction lows, many reaction lows. This support zone on a scale 1 to 5 has got to be right up there with a 4 or 5. So if and when Microsoft breaks that support zone, that would be bearish. And if you're a bull, you can look at it glass half empty, glass half full. I've marked a divergent high right here. If you follow the vertical line up top, you can see Microsoft putting in a double top high, equal highs with the MACD and RSI making lower highs. But in the near term, if we do break that support, just something to look out for. There is bullish divergence now on the daily chart here. There already was right here at this point, right there. Nope, actually the divergence, we had it confirmed right here. The MACD is starting to cross over. So what I need to see to get technical, splitting hairs here, I need to see another low. Come in, take out that previous low, and maybe break through there. There is a potential, if and only if Microsoft reverses, that might be bullish because there's that bullish divergence in place. But this could very well be burned through. And most importantly, would be a break of support, which when that happens, if that happens, that's bearish. What would be bullish, again, would be a reversal, strong reversal back above there. So just something to watch, because these are, again, the leading stocks, top stocks in the Nasdaq 100. Here's Alphabet. This is the chart I was putting up recently in the trading room. Divergent high. You see a lot of trend lines here. Breakdown, back test, high level back test, I call that, where you're crawling up along the trend line afterwards. Prices finally rolled over. This yellow line is a pretty key support level with a additional support level. So call it a zone right there below, around 668.25 would be the bottom of that support zone. So we'll color that line yellow just to kind of call support zone a zone if it's too two support levels in close proximity. I refer to that as a zone. So that's a level to watch, and if that goes in alphabet, then that opens the door for a pretty big move down. Here's that 60-minute chart. I've been updating since we were within the wedge. I've heard over times I hear technical analysis doesn't work anymore. It doesn't work for every stock at every point in time, but it's worked extremely well in a lot. This one I outlined all these levels here, all these horizontal lines, and showed a move down with reactions. We had reactions off, meaning a bounce off every single level except this one right here. We punched through there after we had that reaction I was expecting, broke down, and that was my target. When we hit that, I drew a little arrow that showed a bounce, I believe. It's exactly forecasted right up to that former support, then resistance zone. And you can see that's where it stopped cold. And we traded a little sideways since. Now we've dropped below it. So I'm not trying to harp on all the, how well the technicals work there. Most importantly, the point I'm trying to impress is that 689 level was a key level. That was my near-term target. It was hit. We had the reaction. Our reaction is a consolidation and or bounce. We had both, consolidated in that range. And now look at this, broken support. So that's pretty bearish. But again, zooming out to the bigger picture, there's some reactions here. So you want to see that lower level there go around 668, we'll call it. All right, that's Google. Here's Amazon. Amazon's a short trade on the side, an active short. There's that ascending price channel. We had one little whipsaw signal, but prices have since broke down. Went sideways for a little bit and are now moving lower. That was on a divergent high, as you can see here. And let's see, 60-minute chart. First target 687.10. Did we already hit that target? I'm trying to recall right now. I'll have to check. But either way, we're close. We almost hit it today again, and these are additional targets. So we're moving down. We couldn't once we broke back below that 723 level. You can see it was a ceiling, a brick wall. And Amazon tried many times to get above it, and now it's moving down impulsively lower. So again, the common theme here is the technicals are just being affirmed with today's move down, and some people are going to chalk that up to a one-time event, overreaction on Brexit. You can do that if you want. I trade the charts, and the bearish case that I've been making has only been considerably solidified today with all the price actions. So at this point, my conviction's even stronger that you want to short the rips, especially into resistance, and depending on your trading style. And I want to digress for 1 second because there was a comment in the trading room. I see this that a lot of people covered and maybe you did good. If you covered the gap down today, you did good, but you were almost back to that level now. And what I'm trying to say here is define your time frame. For example, if you went in to swing trade the broad market or a sector, and let's say you were shooting for I'll just use a round number, 30% drop. Let's say you were shorting a leverage ETF, looking for a 30% drop, and you allowed yourself a 10% stop loss. And let's say on today's gap down, your position was 10% profitable and you covered. Well, what you've just done there, you've effectively shifted your trading plan. You started out with a 3-to-1 RR, risk-reward ratio, which is typically the minimum I like to take on a trade. And you've modified that to a 1-to-1 RR. There's a saying in Wall Street, an old saying is, you can't go broke taking a profit. Well, you can go broke taking profits early if you continually do it. If you're, allowing yourself 10% stop losses or whatever your number is on a trade, and you're taking profits, quick profits, and you're modifying your trading plan as soon as you get them, and you're taking 10% profits, closing out that position, well, that's a 1-to-1 RR, and unless you have some phenomenally above average success ratio on your trades, you're going to end up losing money over time. So in other words, stick with the trading plan. If you're nimble, again, you want to cover the gap down, sure, and then reshort the bounce. That would have worked out very well today. But my point is, going back to here, if again, depends if you're bearish and you agree with the long-term analysis, if you agree that this was a great shorting up here when we had that confirmed failed breakout, the divergent high, everything else, which points to a trend change that's probably going to last weeks, if not months, more than likely months. So you're looking for these longer targets, then you need to ride out. Is it painful to watch, some profit give backs on a big gap down like today? Yes. And again, if you're nimble, game it. Cover it there, try to reposition short. But you also have to know what you're going to do if we would have gapped down and kept going. Would you get back in at a less favorable price? Those are the things you have to think out. And those should be identified ahead of time in your trading plan. So for most of you who are swing traders, my suggestion is get your trading plan, define your stops, define your targets, and stick with it. And if you need to set those, use those OCO. One cancels the other orders. It takes the emotion out of trading and allows for discipline. In other words, you set your stop, you set your profit targets, and one or the other is going to be hit. You don't do anything. You leave that order good to cancel, and you do that enough. And if you're very selective on your trades, picking the trades with the best RR, objective entries, more often than not, it'll work out for you. And again, if you're using a good 3-to-1 or 4-to-1 risk-reward ratio, you don't have to be successful every time. In fact, you don't have to be successful even half the time. That's the whole point of the RR. Okay, enough on that. I just wanted to kind of share my thoughts, and more importantly, share my thoughts that, as much as it is nice to see a 3% drop in the markets today, define if that's what you're doing. If you're a quick trader and you're happy with a 3% gain, or you had TZA or something else where you're, up 9% or so, IWM is down 3.41, so that would give us on TZA a gain of 10%. And if that's what you were looking for and that was your plan, take it out. But if you had a target of 10% on the upside, that has to assume that, let's say you entered yesterday in anticipation of this Brexit mess, that you only had a stop loss of about 3%, because if you had a 10% downside, then it would have been a wash if you were stopped out. Okay, I think I made my point. Although that last part might not have been clear. It's not a wash if you're stopped out. Anyways, this has been Randy Finney with Right Side of the Chart, and as I said, I will, over the weekend and throughout today, post some static charts, focus on any individual sectors that stand out, as well as update the trade ideas. There's several that have been stopped out that haven't been removed yet, so I'll put up some posts on those, move those out, and over the weekend go through the charts and try to point out any standout trade ideas. And for those of you who are bullish and long, the same thing I just said a minute ago about the short side traders with your trading plan stops, same thing holds true in reverse. If you're bullish and you think this market's going to new highs, you want to step in with both fists and be buying right here. If that was your trading plan, if you're looking for a pullback to add to your long positions or get long because you think the market's going to new highs, I don't see why you wouldn't be stepping and buying the support level. Again, it's not my expectation that that level will hold, but if you're bullish and that's your plan, this is when you want to be buying, when the market's down 3%. You don't want to be buying when the market's up 3%. You want to be shorting when the market's up 3% into resistance, if you're bearish, that is. So I know it's hard to do, but that's trading. You want to buy when there's blood in the streets, and you want to sell when the euphoria is so thick in the air you can slice it with a knife. All right, this has been Randy Finney with the Right Side of the Chart. Hope you enjoyed it.